Okay, we're live. Welcome to Dallas office. How is everybody today? Got a good event planned. I'm going to try to share my screen here and do a couple quick housekeeping items. Here we go. I believe there we are. REDNews 2021 Dallas Office Summit. I'm sort of getting tired of the Zoom grind. I'm sure you all are too. We really thought this event would be live by now. Had a vaccine for a couple months. Let's get the bus rolling a little bit here, maybe. I don't know, but counting on seeing you all soon in the future. Thanks to CCIM and crew for helping us out on this. This is us, REjournals. In case you weren't aware, REDNews out of Texas. We purchased that a year and a half ago, and now it's part of a bigger group. We publish 6 publications across 17 states, and we do about 150 of these events a year. Don't forget about the chat box. That's where you're going to be able to say hi to each other and network, so you can network with people, other people that are on. You can also use it to communicate with our panel if you have questions for them. There's a trick to the chat, though, in Zoom. You have to click on, when you start typing in, they'll see a box that says 2 panelists, and you have to click it down to 2 panelists and attendees if you want everybody to see it. So don't forget to click that box so that everybody sees what you're doing. I'll try to jump in and remind people if I see you're not doing it. This event's been approved for Texas Continuing Education. The trick here is you got to log in, you got to stay logged in, and you got to stay logged in until the end, and then you log out. And we track that. So we track the moment you log in, how long you've been logged on, when you log out. Don't forget to do that, or I can't give you CE credit. I'm going to pop up these bios as soon as, or people's contact info as soon as these panels start. I want to do one more quick screen sharing. Just get this one out of the way because it's early in the morning. Here we go. Just hold. I want to show you our virtual lobby. Right here, our tech team spent time building out these virtual lobbies. It's not really like a real lobby. You can't go in and say hi to people at booths, but it's the closest thing we can do in a virtual environment. So you probably saw this when you came to watch this event. You probably clicked watch event here, but if you look down below, you can see all of our speakers and what they're going to be talking about. So if you're wondering who's coming up next, what they're going to talk about, here's their agenda. But the trick here is everybody's got a little LinkedIn button underneath their name. This is kind of our best shot at, hey, at least you can make new connections with our speakers today. So pop that LinkedIn button and say hello to our speakers and connect with them on LinkedIn if you're not already. I'm going to, Sharon, I'm going to get out of your way, let you run the show. I'll be here if you need me. I'll be here to remind you when you've got 1 minute left, but I'm just going to stay out of the way. Holler if you need anything or any tech assistance. Say, hey, Todd, we need you.
Thank you, Todd.
Thank you.
I really appreciate that. And we are so happy to be here today. I'm really lucky to be doing this with Nick and Alex and Jeremy, our young panel with ties on today. We were joking that maybe they had to dust those off, but they look great. This is a fun group, an energetic group, and I can promise you, while I've seen a lot of other brokers in our industry out there having what we call spring break, these guys have been working just tirelessly since March, and a lot of good activity to show and tell about as a result of that. They say that 72% of people like statistics. We're going to talk a little bit about market statistics, but even more importantly, just the general dynamics of what's going on today in DFW and how that relates to what we see nationally as well. Jeff with REDNews, first of all, thank you guys for having us, but he said that if we said the words pandemic, unprecedented, social distancing, new normal, or quarantine, that we would each get charged $1. So you guys have to hold us accountable to that. We'll try not to do that. And it doesn't look like anybody's going to have a dog barking or a doorbell ringing. So far, so good. With that, I will lead it off with the group and just want to talk a little bit about market statistics. The one that comes to mind to me is the 10 million square feet of sublease space statistic that everybody's throwing out. But in general, can you guys chime in and tell the group what you're seeing as it relates to those market dynamics?
So in general, it seems like leasing has been down, but the positive note is that it was up 30% in the fourth quarter from the third quarter, which is a very, very positive sign. In regard to subleasing, yes, the sublease market has absolutely exploded. But I think there's 2 sectors in the sublease market. There's short-term sublease space that is most likely going to sit. It feels like it's going to sit for the duration of the term, but the long-term subleases with furniture in very nice space seem to be getting gobbled up quickly. For instance, we had a 60,000 square foot sublease on the lower tollway, and it was leased within 4 months. 90% of it was leased in 4 months, and the other 10% we're getting calls daily on it. There's a ton of action. So we're seeing a lot of our clients actively look for long-term subleases right now.
Yeah, I'm going to agree with Nick on that. There is a ton of sublease space out on the market, and there absolutely are two categories. It's the good and the bad. And I feel like when all this hit the fan, basically back in March of 20, there was a corporate responsibility to put their space out on the market to see if they can mitigate some risk and some liability on their rent. And exactly what Nick said, the good space gets gobbled up quickly, the bad space sits. But it's always a topic of conversation with our clients. What's out there? Where is there a deal? Is there furniture included? Who's looking to be more aggressive than others?
So coming from an owner perspective, and my name is Jeremy Duggins. I'm with Cawley Partners. We're a local investment development shop here in Dallas. We've got a couple million square feet of office product on the ground today. Most of our projects are from down in the Turtle Creek area all the way up into Legacy and Frisco. We've got a couple million square feet of proposed projects we'd like to get out of the ground in the near future. But when all of this kicked off, we had a project that we were getting ready to pull the trigger to go spec on. And typically we like to go with some pre-leasing, but we felt like the market was moving fast enough. There was enough velocity of just customers taking down space that we could go. And completed construction drawings, ready to go. We had a couple of users getting really interested in our project. And then as everything started to change, one of the users we were chasing decided to pivot from brand new, high-end, new development to looking at really nice sublease and nice market. So from the development standpoint, it's certainly going to slow down our new starts, but I'm positive on it because we saw this happen back in 14 and 15 to some degree. There were a handful of developers like us that went spec up in Legacy all at the same time. And then lo and behold, we had a nice big oil and gas company decide to put all their sublease space in the market. It slowed all of us down. Now, all those projects leased up, all those owners had good outcomes, but it just slowed us down a little bit. So I think that sublease space is going to push us back from a development, from an owner standpoint. But at the same token, it's going to allow us to have the on-the-ground, move-in ready opportunities for those customers who are coming to Dallas right now who want to spin up right away. And I'll give you a small example of this. So we had a co-working operation in one of our buildings that just got destroyed last spring. It closed up, we're gone. And inside of 30 days, we had an out-of-town financial services group come and open an office in Dallas and get up and going because they could take the space, they could go. It was a great submarket, and it was a phenomenal value. So we have a lot of sublease space. It's going to slow us down, but long-term, I think it's going to help our market stabilize and grab more market share of those good jobs and those good companies we want here.
Well, and as an owner, you're supposed to say that it's not going to affect you either, right?
I am, but the reality is it is, but it just means that, right now, there are a handful of guys going spec and they're going to do great, but everyone else really tapped the brakes in this last cycle, and most developers were only going with some pre-leasing, or if they were going spec, it was part of a larger development where it was a small percentage of their overall footprint. Kind of like if you've got an owner building out spec suites in a building and they're going to do 10% of their project, you've got developers going spec in their giant developments where it's still only just adding on to their occupancy. You saw Grant doing this, you saw Harwood doing this, Billingsley has continued to be successful doing this, and so that development will continue to do well, but just the random spec buildings all over town, that's really slowed down and kept us really healthy.
Yeah. Plus, Sharon, we know Jeremy and Cawley will get aggressive to win business, right, Jeremy?
You just said they'd give away deals, I think.
I heard that.
Absolutely. Absolutely.
When we were talking about this topic earlier this week, when I heard the phrase subleases are being gobbled up, I think that was reiterated yesterday in another market overview. And it kind of took me aback because I wasn't really thinking that, right? I was just thinking more sublease space on the market every single day. But what's happening is that we're seeing the ones that are ready to go and have some term left on them. Those are the ones that are coming off the market pretty quickly. And they also, I think, you guys can correct me if I'm wrong, I think they tend to be in the more suburban markets or lower rise office type stuff, because I see subleases in downtown as an example. It's just a bloodbath. I mean, nobody wants to get in elevators, and nobody wants to deal with all the things associated with that. Would you guys concur with that?
Yeah, I would absolutely agree with that. Downtown is a whole different animal than, say, far north Dallas. I think we're seeing a big bulk of the sublease market in far north Dallas. But where there's a high density of people in space, that's where it seemed like there's a ton of subleases out there. But again, I think it comes back to corporate responsibility and some executive decisions to be made while we're going through the word we don't want to talk about, pandemic, until there's enough vaccines out there, right, to come back to work the way we were in 2019.
Thank you.
And I think there's a third factor to it that's there's sublease that's out there because the existing tenant is hurting financially, and those subleases will sit for a long time. But if the tenant's credit's stable, if they're a strong tenant and they've just decided to work from home for the near term and figure the rest out later, that's the space that's getting gobbled up. And you can tell the difference pretty quickly.
You also have companies like Michael's who did a big, huge corporate headquarters relocation during the midst of the unusual circumstances we were having at the time. Mm-hmm. And they weren't afraid to put their space on the sublease, so it's not always dire either. But how do you think we compare to the national market as it relates to this topic?
I think nationally we're out in front of it. We get a report from one of our vendors that tracks card swipes at office buildings, just as far as people getting back in and moving and actually showing up to the office. Texas, all three of the big Texas markets, Austin, Dallas, and Houston, we're all clearing 30%. Dallas specifically was leading the market at 35%. You've got New York and LA way below that in the 12 to mid-teen range. And so we've got a lot more people moving and actually getting back to work here. And I think, we were seeing great growth for all the companies here in Dallas, great absorption. And now you've got all of that happening as well as everyone coming here. I think we're going to be way above all of this. I know there's a lot of sublease space on the market right now. The good stuff's getting gobbled up. We had a customer put 2 floors of sublease space on the market in Legacy, and it went within 30 to 45 days at great rates. And so the good space is going to go, but we're going to continue to lead the market. And the other thing about all this is we were having people moving here in record numbers before all of this, and that's only going to accelerate. And it's not just your big companies, it's your little guys too. I had customers calling me from the Midwest where they're just packing up and bringing their companies down here. We've got a customer or a client that has property all over the country. And some of their analysts in New York just said, hey, we're done. And we're just going to relocate to Dallas because we can get outside, we can go to restaurants, we can see people, we can be safe. And so I think all those things are going to push us to it's going to be a dip for the time being, but we're going to see huge lift in the near term.
Totally agree with that. What are we seeing as we drill down into Dallas-Fort Worth as far as just trends as it relates not necessarily to space use, because we'll get into that, but as far as because of the market dynamics, what owners are and aren't willing to do, and any trends we see with things such as rental rates and concessions?
Sure. I guess I'll lead that one off. Landlords, because of the sublease market, are definitely having to get more aggressive. But when it comes to what makes a landlord excited about a deal is the timing and credit of a company. So if our job is to provide the details a landlord needs to evaluate a company and to evaluate a deal, and there is 100% concessions that are happening now that weren't happening a year ago. I think there's a short lifespan on this for maybe another year, but this is the time right now to really reevaluate your business, your lease, make sure it's fully functional for your operations and your workplace strategy moving into the future with your employees that are actually coming in.
Yeah, I agree completely with Alex. And so what our clients are seeing is the large Fortune 500 companies seem to want to still put this real estate decision on hold for the time being, and that might be due to liability issues until they change the laws associated with that. But the majority of our small to mid cap companies and clients seem to just have the general feeling that I'm ready to get back to work. And with that, they've been putting off decisions as well. But now that the vaccine's out, now that they understand what Alex was saying, that the current concessions that we're able to acquire for our clients right now are so good that our clients are making long-term decisions and taking advantage of the twice amount of free rent that we're able to acquire now than we were 2 years ago, the higher tenant improvement allowance that we're able to acquire now that as opposed to 2 years ago, and just the general creative concessions that we're able to get. And they're really taking advantage and making long-term decisions.
From an owner perspective, we're seeing kind of the same thing. One thing that really changed in the last, 24 months is we're seeing many more owners, and we kind of learned this lesson from the co-working groups, is that flexible space is important. We saw some groups coming to the market really shake things up, very in particular, really started to show us space as a service. And they did some big plays by buying buildings and having huge flexible opportunities for companies to grow and come in, almost like the co-working or what we saw with spec suites, but on a much larger scale. We're seeing more owners approach those types of customers where typically they would want 7 or 10 year leases for big space, being willing to do shorter terms for these growing companies where they may even do 2 or 3 year deals for 30 to 50,000 square foot users, which is kind of unheard of. And they're getting great rates, and a lot of times they're providing it with furniture. So there's a lot more flexibility that's happening in the market. We had in our portfolio a handful of assets that hit some of the highest rents they have ever hit for those projects during the cycle, but it was all based on flexibility for the customer, where we could give them space that they could get up and running and give them the flexibility of a shorter term where it would allow them to grow rapidly. And the owners were willing to take the bet on, we want this customer here, we'll take a shorter term betting on that they're going to grow in our building and be successful here. And the customers were fine paying higher rates because of all the other reasons. So we're seeing that trend a lot. And we're also seeing owners convert assets. So we've got one asset in particular, and we're seeing this with some of our competitors, where they're going to build out giant spaces for flexibility, where it's kind of a hybrid between the sublease opportunities we were talking about a minute ago, but now you're seeing it on a direct level.
What about the lenders, Jeremy?
It all comes down case by case. Some of on our projects where it's not a huge portion of your asset, you can get away with doing it. Usually these are on assets where they're stabilized or they have more runway. Obviously the ones where they're host, but these are on projects where there's enough runway where the lenders are getting comfortable with.
Well, you touched on new developments a little bit, but I think that there's a little bit more to that, because although companies like yourself have a great model, and I think that's why you're going to continue to be successful in new developments, I've seen some of these larger developers pull back right now, and they're a little bit more, maybe not as bullish as you are on the new developments, but you and companies like Billingsley, I think, are faring well because of your product type.
Appreciate that, Sharon, and it's always great working with you on these. What we saw in the last cycle is a lot of buildings were able to justify the higher rents by stretching the parking ratios and giving customers more density in their space. So customers were coming out of B buildings or A- and going into new development to get newer space to tighten up their footprint. and have a bigger parking ratio. Now we're going to see a similar approach where customers are still going to have a flight to quality, but instead of a parking ratio allowing them to get more flexible, it's going to be a work from anywhere that's going to allow them to be more flexible. And so we're going to see more customers. There still will be new developments coming out of the ground. They're going to have a lot of build to suit, a lot of pre-leasing is going to be required to get those deals done. I was at the user yesterday that can do whatever they want, and they're exploring nice new high-end development because they're looking at recruiting the long-term future for their company. And I think they're going to pay the freight to be in something nice new. Maybe us and maybe another market. I think customers still want that. Now they may take less space, and they may be more thoughtful with how they design their space. We've got a user today in one of our assets, one of our new projects, financial services group, that actually they had a really long-term lease, and they actually pushed out their lease well beyond 12 years, I think almost to 15 years in the middle of all this, because they were betting big on Dallas. They had a lot of flexibility or design, and they really valued having a long-term home for their talent where they could be competitive in the marketplace. So those things are still going to drive it. You know, the development you're in, if you look behind you, I mean, that's right where Dr. Pepper was building their new campus. I think they're going to kill it. The Star is going to do fantastic. If you look over at Frisco Station, Van Trust, they're killing it right now because everyone wants high-end quality.
It's an interesting topic as we shift into the topic of trends of space usage and things like that Alex and Nick can tell us what their clients are doing. But we did have that conversation yesterday. So right behind me is the future corporate headquarters of Dr. Pepper Keurig. Can't see it because when this picture was taken, it was early last year, and now there's a big tall building behind me. But we all were curious, how is all of this going to impact that move? And I think the answer is probably in a positive way. So Alex and Nick, trend-wise, tell us a little what you're seeing with the companies that you're representing, and with whether it's renewals, space usage, anything you want to talk about there.
So our clients in the mid-cap and the service industry seem to be expanding. For instance, in the financial industry as well. So we represented a bank that's new to town in Preston Center submarket, and put them in their first spot. And we put them in the fourth quarter of last year, and they're already doubling in size. And in the last 6 months, we have expanded a CPA firm, a tech firm, 2 financial services companies, and a headquarters for an international manufacturer. So I would say if you are in expansion mode, people, again, are taking advantage of the current concessions that we're able to negotiate for them. But if you're not in expansion mode, the trend seems to be taken, like Jeremy said, looking at higher quality space and taking 5 to 10% less space. And that's due to the fact that some business functions they figured out can happen remotely.
I agree with everything Nick just said. It really just depends on the company, its size, and its culture. One of my larger clients has 270 offices across the country, and they were too big to slow down. We were too big to shut down offices and renegotiate, rent abatement while we're not using the office. But it was very interesting seeing the tone of landlords change from, say, January of 20 to May of 20. For instance, in Manhattan on a renewal, we negotiated about a 30% decrease. And it went from me making the initial contact in January with the woman who was the asset manager not answering my phone call to, how can we help you today? What do we need to do to make this deal happen? And that was a similar conversation in Chicago and Southern California. When it comes to local businesses in Dallas, I think most of them are very hungry, and if they already haven't, are going back to work. It's interesting because it all comes down to culture and it's usually a top-down model on who's leading the charge. But I really feel, and Nick can probably agree with me here on this, is that it's the younger folks that want the energy and the camaraderie and feel like they have a purpose, that really want to be back in the office. It's a little bit more challenging with people with kids if they're not in school and their responsibilities at home. Hopefully that will change sooner than later. But there is 100% companies back in the market. I have a tech client that needs to be undisclosed, but we're looking in multiple cities to grow their footprint, not only just Dallas. And what we found is that we couldn't attract the same talent we could in Dallas that we couldn't attract the same talent in Salt Lake City and say Vegas that we could in Dallas. So now we're looking at growing their footprint threefold, basically.
And I would also say that from a space change perspective, due to the pandemic, and if you have a long-term lease in place, I see little to no drastic changes or modifications to space. Like you hear that people are trying to build private offices and go away from the more bullpen cube scenario. I see very, very little of that. And even on a renewal or an upcoming new lease, there might be slight 10, 15% change to more private offices, but nothing. I see none of our clients going from full open to full private.
Yeah, I would echo that. I think it's a combination. When people ask me about the office market, I describe it as just, well, it's weird. It's all across the board because you have companies that are growing and bullish. You have companies subleasing their space. You have companies that haven't even gone back to their offices. You have companies that put deals on hold, and then ones that are doubling down. It's just crazy. So it's all across the board for sure. Jeremy, any comments on that?
We're seeing all the exact same things you guys are. So it's, some of them, the space plans haven't changed at all. Some of them, they just want a little bit more private, but nothing drastic.
Let's talk about corporate relocations. That's in everybody's daily life right now. Just looking at my list, and this isn't just Dallas, but Elon Musk moving to Texas, CBRE relocating from LA to Dallas, Charles Schwab, Hewlett Packard to Houston area, Oracle, Peloton, Independent Financial, National Rifles. Every single day, there's a new positive announcement, and I'm so grateful for that, and I think it's going to continue. We also haven't even talked about something that just came to mind for me, but the industrial market, as you know, is just on fire. I mean, it's just crazy all across the country. Dallas is one of those top markets, if not the top market, and so certainly will also be a recipient of office type users as a result of the industrial use as well. Now, corporate relocations are happening every single day, and I want to hear what you guys are seeing as it relates to that. Whether it's West, we hear a lot of the West Coast. What about the East Coast and all the coasts?
Well, the market, I think, obviously, so the metric that we're seeing is that about 40% of DFW is operating out of our office compared to the coasts, which are 18 to 20%, 21%. So I think that that coupled with the no state income tax and the high level of employment, employees here in town have been drawing all these people, it's what is it in the last 2 years, 74 headquarter relocations have come to Dallas, and 91 are currently proposed, and that number climbs. I mean, that was a number from like a week ago. I'm sure it's 95 by now. So the absorption long term, I think, will be very, very positive for the next 10 years.
Absolutely. I'm a perfect example. My wife and I moved from Southern California 10 years ago to Dallas and haven't looked back. The pro-business climate, the better quality of life. We can talk about corporate relocations all day long, but the reality of it is that about 50% of all companies out there are considering something in Texas at this point. So we should be very fortunate and very lucky to live here.
Yeah, if it's not a corporate relocation, it might just be expansion.
100%. And going back to industrial, Sharon, I mean, we're in the middle of the country. It's getting more and more competitive every day. And it seems like you're always trying to beat somebody out for a building nowadays.
Well, we can rest assured they're probably not moving here for the Cowboys, but we hope that changes. My sister moved here a few years ago, and I told her she moved to Dallas before Dallas became cool. Now we're trending. Jeremy, were you going to say something?
Well, I was just going to echo what they're saying, but also I think there's even more deals and clients that are on the list that are just kind of on their own, starting to come to the market and look. You had the announcement yesterday about the bank where the CEO just bought a house here in Dallas. I was on the phone with a group out of California that's not on any list, it's not represented, that's starting to kick tires and going to move a large operation here. And they're also looking to park their money here. And so we've seen some incredible trades happen in the office space where we've gotten some phenomenal cap rates. And so people are seeing bigger investment opportunities here, but also a great place to bring their companies. And I know that, like every other market, we did have some job loss here in Dallas, but on the other end, we've got a lot of available talent now. We've got a lot more available talent. And a lot of our students are staying here in Dallas and not leaving because the schools around the country are closed. Just an example, we had one role that we were looking for here, and we had just an incredible list of applicants, incredibly talented kids, way smarter than me, looking at this job, all MBAs. And so the talent available here is fantastic for these companies who are looking to get in and get up and running. And so if people want to shop, they need a lot of opportunity. And right now there are over 100 proposed developments in DFW, something like 46 million square feet of potential space that could come to market. So if you're a customer, there are buildings going up right now that are fantastic in Uptown where you can go. There's opportunities in Legacy. You've got opportunities in Las Colinas. You can kind of pick whatever you want. You're not limited. And so just getting somebody here, I think once they're here, they're going to land. And so we just have fantastic runway in front of us.
What are you seeing as it relates to Uptown and downtown relative to suburban and northern markets?
I've got limited that I can speak on here because we really only have one asset in the Turtle Creek area. I'll just say that from our activity, we just see more activity as you go north for what we have. I'll let kind of Nick and Alex speak to what their clients are seeing down the Uptown.
Yeah, literally going through it right now. We are looking from Uptown Turtle Creek up to, say, George Bush, so Addison area, and it all revolves around where do the employees live. They want to be fair to their employees. They want to make sure that they're not commuting an hour and a half a day when we get back from traffic. They want to make sure they can go buy a $10 lunch, not a $25 salad. I think there are some markets for every company and the culture, and it just seems like most people are gravitating nowadays a bit more north.
I agree. The north, I would say that many of our clients that are currently located in Uptown for the first time are considering northern suburbs. And not all of them are committing to it or moving there, but it's now under consideration.
Do you think that some of those buildings have a lower parking density? Do you think that as a result of the dynamics in the market with people doing more work from home and things like that, that the densities and the parking requirements will be lower, which would help some of those type of buildings?
I feel like the high density users are a lower percentage than what most people assume. I feel like 3.5 to 4.5 to 5 parking spaces per 1,000 square feet seems to fit 90% of most users. So I would say it hasn't been that big of a factor with our clients.
Alex, I'm not hearing you say that either.
No, I agree. I mean, parking downtown is a challenge, right? And uptown is the same way. If you're north of 4 per thousand parking, you're going to have a little bit of a struggle, but there are ways to get creative with landlords. And nowadays, workplace strategy, flexible work days. I'm not saying that there's going to be a ton of flexible work days in the normal week moving forward, but there are ways to get creative to make sure that a building can accommodate parking. I mean, Jeremy knows that you can oversell parking, but it never actually happens. So
I've got a friend who is in sales, and he's been in Texas a lot lately. And I asked him why, and he said, "This is the only place where people will meet with me." And he said, "I've got clients in California. I've got clients all over the country. And I come to Dallas because people are working. People are getting out. They're going to lunch. They're going to dinner. They're willing to meet with me. They're not scared of me." And I just thought that was a very interesting case study from one individual who lives in Maine, that he's coming here to do his business.
You bet. And I think that that's a big reason that the headquarter relocations will continue to rise, because on the long-term horizon, there is less likelihood that Dallas or Texas will do a full shutdown like the coasts.
When do you think that we will be at a higher density than where we are today? Because what was the stat you threw out? 40 something?
I think around 40% seem to be going back to the office.
I mean, I've heard maybe 80% at the end of the summer or in the summer.
yeah, I have a few physician friends, and they seem to think into summer Q3-ish, there'll be enough vaccine rollout. Hopefully that stays on track with the distribution of it all. But that was kind of the hint they were telling me.
And we hope it's 100% before you know it. Corporate relocations are the hiring, and the people and the taxes are part of that. The housing market's got to be part of it too. You can buy a house for, it costs 1.5 times more other places, but part of the problem is we've got 6% less inventory than we had this time last year, I think. So how are we solving for that kind of interim problem?
Well, it's interesting seeing like the multifamily market right now in Dallas going through the roof. It's impossible to buy anything. I mean, if you're trading a building, it's a sub 5 cap. I mean, might as well have a municipal bond. It's crazy. Industrial is right there with it too. It's institutional money. But, the beauty behind Texas is that we don't have any geographical boundaries here, and we just keep pushing north, south, east, west. So, interesting watching home ownership as corporate relocations happen and business gets back to work. Come from California, I think Texas is great. It's a way better cost of living, but it has been very interesting, Sharon, watching home prices keep going up and up.
So one thing we're all getting spoiled with right now is really not having bad commutes. I don't know about you guys, but the last almost year, it's been way better getting in and out of the office. And you almost forget what it was like beforehand and how jammed up things would get. And so as all these big companies kind of roll into a new model of kind of work from anywhere, where they've got some flexibility when their employees are in, when they're not in, I think that's going to transition into more people moving out to these areas that, I'm a Dallas guy, I grew up here. Salina and Prosper seemed like Oklahoma. And now you're seeing phenomenal housing developments going there. I think you're going to see more people continue to move a little bit further away and be okay with more of a little bit of a longer commute, because everyone's more flexible in their daily traffic and when they're going in, when they're not going in. So I think we're going to see more housing developments pop up, and it's just going to continue to push out as people have more flexibility with how they do their work.
Well, I read last week that the permitting is an issue with a lot of the new developments on housing, and that reminded me too, we talked about permitting on projects here on the office side in the city that we work with, and what a challenge that can be. Are any of you experiencing permitting delays that's impacting your projects?
Yeah. Go ahead, Jeremy.
I've heard stories of 10 to 12 weeks now of what used to maybe be a 4 to 6 week type of cycle, which is, that's prohibitive if you're sitting on the sidelines for 3 months.
Yeah,
We have some great cities that are working. Yeah, you go ahead.
I say it's pretty challenging sometimes right now to build a timeline for your client, right? You try to do your best to give them some landmark dates to make decisions, to get in on time and to not be rushed and make rash decisions. But yeah, permitting is becoming a challenge in city to city.
We had 2 new starts this year on new buildings, and both cities worked really hard and did a fantastic job to help those get started. But the customers also kind of realized, hey, there's a lot of reality going on in the world, and we just need to be a little bit more flexible. And so everyone's working together on a moving target, and we're gonna get to a good outcome. But I think everyone's got their eyes open and trying to figure out how to make these things get across the goal line and solve the problems and work together with the cities. I'm thankful for how the cities have responded, done a really good job.
And from the tenant perspective, we have seen projects go over, and in the past, the tenant would have to pay holdover in their existing space. But we've seen some of our clients have the ability, since everybody has the ability to work from home now, they can go home for 2 or 3 weeks until their space is done, instead of pay that 150 to 200% holdover.
Absolutely. There's a company that just moved they're moving their headquarters, but it doesn't start till March 1. They just moved out yesterday, and for the next month, they are working from home to save that holdover.
Mm-hmm.
We have a few minutes left, so we want to answer a few questions if we can, but is there anything else you guys want to say as far as just general forecast or any comment on the market that you feel like we haven't covered that you wanted to?
I would say that I've more so now than ever, more clients of mine that are tenants in multi-floor office buildings have asked us to research and look for standalone buildings to purchase. And even tenants from 3,000 square feet to 100,000 square feet, that seems to be a common thread in our clients. And for that reason, the purchase market is as tight as it's been and as expensive as it's ever been.
Great point. Why do you think that is? Why do you think they want to buy?
I think it's twofold. I think the main reason is a lot of clients have capital to deploy right now. I think that's one of the main points, and also that they'd like the idea of entertaining their own space and being able to control ingress egress.
Alex?
Yeah, absolutely. My best advice to my clients right now, if you're comfortable with your business, you're full steam ahead, regardless of work from home, work from the office, you know you're going to be back eventually, to really take advantage of the climate right now and to extend your lease and to reap the benefits of the awards that we did not have the last 13 years. And I echo what Nick said, with interest rates going on right now. You know, you can go for a 10-year plan and you'll actually do better. So it makes a ton of sense.
So question and comment from our friend Steve Midori, who everybody knows Steve. He's a real estate rock star.
He's on the next panel, right?
Oh, he is. Well, he's trying to get all of our good information for that then. But he said, Nick, so if you have a vacant building as an owner, should you wait before cutting it up for a sale or single tenant lease first?
It's a good question. I would say that if you have a large single tenant or 2-tenant building, to cut it up into full multi-tenant small tenants, I would probably wait. That would be my I would wait until the demand increases for small tenants.
What do you think, Alex?
I think it all depends on the building and the lending. I mean, I'm a sucker. I'm a bird in the hand, right? But if you can maybe cut up a building floor by floor and maybe not multi-tenant an actual floor, because I know that can get real costly. And Jeremy can probably speak more about that cost, but would probably say, I'm going to go against Nick. I'm going to go bird in the hand. I'm going to say make a deal.
Here you go, Steve. You're going to do whatever you want anyway. Anything else? We've got 1 minute left.
I'll just say that the customers we talked to were bullish on Dallas. We had a customer with some sublease space in the market, and they pulled it because they're going to bring more of their business units here. We also had groups extend out leases well beyond 10 years because they're bullish on Dallas and having their businesses successful here.
No doubt there's some challenges, but we're very blessed to be in this market for sure. So hopefully, I know you guys you're really on the call because you're getting 2 hours of credit. And I hope this has been more fun than learning about lead-based paint forms and buying houses. We had a low bar to meet.
We met it. We crushed it then in that case. Hey, I've got a question for y'all. As I've been reading about corporate relocations to Texas, a lot of them going to Dallas. A lot of the articles say, well, they already had a presence in Dallas and they really weren't moving a substantial number of employees. Have you seen the influx of people along with their companies from California, or is it just sort of a headquarters move for posterity's sake?
Yeah, it's a mixed bag right now, right? So you have 2 reasons to move. One, because your employees want a better quality of life, and I'm seeing people put in transfer offers. But also it's for tax purposes. You want to move your headquarters to Texas solely for tax purposes, and you're really not moving a huge bundle of people. So it's case to case.
So from the residential real estate perspective, a friend of mine said that local DFW home buyers are having to compete, that generally take a note on a house, are having to compete with New York and California buyers looking at these houses, making offers, and putting contracts on sight unseen, all cash. So that tells me that that they are moving here. And another thing, I've talked to several just young people that are trying to get into certain industries, and they're moving here without a job because of the job perspective moving forward, and they think it's a happening city, and there's more likelihood that they'll find employment here long term.
Well, I think they're right, for the record. So that's great news that you're getting some activity. It's a bummer for the people that already live in Dallas and are just trying to maybe move school districts or something like that. But what do you do? It's that's the pain of growth. All right. If you're on the next panel, go ahead and turn your cameras on and microphones on. We'll get that rolling. If you just finished on this panel, you can turn your camera and microphone off. Stay right where you are. Nobody will know that you're there. Just make sure you keep those off throughout, and nobody will see you. Quick screen share here again. This is our next panel. Right here, don't forget about these LinkedIn buttons. If you click on the next panel, you can see yours truly. I'm happy to connect with anybody on LinkedIn. I've got a pretty good base of commercial real estate around the Midwest. So if you're looking to make connections, I can help you out there. Let's rock and roll here, Chris.
Yeah, thank you, Todd.
Husky is our moderator. There we go. We got everybody looks like they're here. I'm going to step out of your way just like the last panel. If you need anything, just holler, hey, Todd, we need something. Otherwise, you're free to go.
Perfect. Wonderful. Thank you, Todd. And thanks everyone for joining us this morning. That was a tough act to follow after that first panel. They had some great insight, but I think we have a great group for you this morning, most of which need no introduction. But if you don't recognize one of those smiling faces in front of you, we've got Steve Midori, which don't see him popping up yet, but I know he had a question come in recently. But Steve joined Champion Partners in 1993. Currently serves as one of the firm's 2 managing partners. There he is. Champion focuses on the office and industrial sectors in Texas, with the vast majority of their experience being in the DFW metroplex. We've also got Grant Pruitt. Grant is the co-founder and managing partner of Whitebox Real Estate. Grant launched the firm as a tenant-focused real estate advisory, investment sales, and development firm specializing in offering a custom, tailored approach to his real estate clients. We also have Chris Murphy as vice chair at Newmark. Chris specializes in investment sales for office and mixed-use products in the southern United States, with an emphasis on major Texas markets in Nashville. So, great group here. We've got some good insights. We're going to try to make this a little more of a conversation and a little less of a question and answer as we go forward. But thought we'd get the ball rolling by maybe turning it over to Chris Murphy to give us kind of an overview of the office capital markets realm, maybe from a cap rate, sales volume perspective. And Chris, maybe you could start out with more of a national view and take it down to more of a state level for everyone.
Yeah, sure. Happy to, Chris. Can you guys hear me?
Yes.
Absolutely. Okay, great. Well, thank you all for joining. As Chris mentioned, Chris Murphy with Newmark help run our really central U.S. office sales team, primarily covering the Texas markets. And as Chris alluded to, I'll touch just a little bit on what we saw in 2020, which I know we're all, I think, pretty happy to have that in the rear view as it relates to a lot of things, specifically on the transaction volume side of things. So, as you look at, and I'm going to spend a little bit more time on Texas, and I know this has a focus on Dallas, so we'll get there as well. But, you look at the last 5 years, we've had an explosive run from a sales perspective on the office side. We've averaged roughly $12 billion worth of sales over the past 5 years. To put that in perspective, last year we did about $4.5 billion. So we were down 65% last year from a sales volume perspective in Texas. And I think, quite frankly, each of the four major markets perform in fairly varied, have varied performance, frankly. So, the most drastic fall off in volume was really in Austin and Houston. Not quite so much DFW, and I'll get to that in a second, but the fall off in those two markets, I think, was for very different reasons. Houston, it's well documented energy exposure, significant distress there, and that typically takes longer to materialize in terms of transactions, as frankly, a lot of the volume down there is really banked control processes right now. So we started to see a pickup in that in the second half of the year and expect those to accelerate here in 2021, but it just takes time for those to materialize. So Houston's volume was off. I mentioned Texas was off 65%. Houston was off 75 to 80%. Now, Austin, on the other side, was off probably 85%. I mean, I would say Austin had probably the most meaningful drop in transaction volume, and that's really for a complete opposite reason. The exuberance for Austin, there seems to be a dichotomy there in terms of operating fundamentals and capital demand for that market. The amount of calls, inbound calls we get from capital, whether it's on the West Coast or East Coast, looking for red state diversification in their portfolio, the number one market they all want to look at is Austin, just given the tech focus there. It is clearly the most aspirational market, although as we all sit in Dallas, I've got a lot of counterpoints for why I might want to invest in Dallas before I go down to Austin for a lot of reasons. But all that being said, the capital would love to be there, but because of just the environment we're in, ownership there has very optimistic long-term view and is not going to want to sell in an environment where there might be perceived dislocation in pricing. So because of that, I've seen a lot of ownerships just kind of take a wait and see approach in Austin. And I expect that will catapult coming forward and into the next year, as we're seeing a lot of BOV activity there, but the demand has been sort of insatiable. And then on the DFW side, our volume actually was only off about 50%. We did roughly, Dallas typically does about $5 billion in office sales. Last year we did about $2.5 billion. You peel back the onion on that though, and 80% of that was done pre-COVID. It was primarily done in the first quarter. But I think that's changing. Our second and third quarters last year were very anemic in terms of transaction volume. Our team here at Newmark closed about $200 million worth of transactions in the fourth quarter. And I think the fourth quarter for us and a lot of our competitors started to see some light at the end of the tunnel. And, as we look at our pipeline right now, we're very optimistic about what the back half of 2021 looks like from a sales volume perspective. We have roughly $300 million of product under contract and should close in the first quarter, and probably $1 billion worth of product coming to market here in the next 30 days. So I joke, I have 4 little kids under the age of 7, so I have a busy home life, but I don't think I've ever been busier in terms of work and personal. So it's which is good. After a really slow 2020, I'm excited about what activity is going to look like for the rest of 2021.
Great. No, that was a great insight there. Appreciate it, Chris. And interested to hear, and Steve and Grant, you can jump in here, but interested to hear anything on financing trends. That kind of, you were talking transactional volume and some of those items, but love to hear insights on that. And Steve, I know you've in that realm quite a bit, so if you have any insight, feel free to jump in too.
Yeah, I'll jump in quick because we're always looking in the debt market, seeing what's available. Are we better off keeping existing loans that we have on assets in place? Should we look at refinancing? The debt markets overall are very plentiful right now. The terms at which you can borrow from an interest rate perspective are highly attractive. But what we are seeing is a pullback in the level of proceeds you can obtain, especially for office transactions. And we saw it firsthand this past year. Chris and his team were marketing Tollway Towers, which is a 2-building, 350,000 square foot project up the Tollway for us. It went under contract last January pre-COVID at $51 million. The buyer was trying to get CMBS debt as part of that acquisition and went hard in early March and couldn't close at the end of April when he was supposed to close, all because the CMBS market dried up from a debt perspective. And there were no other viable options either in the life company market, the debt fund market, or the bank market. So we were in a period of about 6 months of limbo, working through a few tenant issues related to COVID, while this buyer kept trying to work the debt markets. And by year end, literally 12 months after we engaged with them, they successfully closed the deal because the CMBS market came back, but they were cut approximately $5 million in proceeds. They maintained their rate, which was in the low 4s on a fixed rate basis for a 5-year loan. And we ended up taking $1 million haircut on the price that we had negotiated pre-COVID. So I think overall, they were pleased to get a deal done. They were pleased to have the debt markets be there for it. And even though we took $1 million price cut on the asset, we were pleased to get it sold in this COVID environment. So I think, and Chris and Grant stepped in too. There is debt. You just need to be prepared to have a lot more equity ready to go into a transaction, no matter what the risk profile is.
Well, I do have one question for you, Steve. We've started, some of the lenders have started talking about non-recourse. And I mean, 10, 15 years ago, that was certainly a little bit more prevalent. But are you starting to see more of the appetite for that?
Everything we've done is non-recourse. So
it is, okay.
Yeah, I mean, which means if you were typically putting in 25 to 30% equity in an acquisition, right, or maybe 30 to 35% on a new development, today you're having to put in on an acquisition, call it 35 to 40%. And on new development today, I don't know what the financing terms would be for a speculative office building today, but I can't imagine somebody being able to get, more than 50, 55% debt. And that's going to be under very onerous terms from probably a debt fund. It's not going to be from a bank necessarily, or if it is from a bank, it is going to have some recourse tied to it, at least for some time period. So, the beauty of this last cycle, while we've seen some adjustment in value, for the most part, there was a lot more equity that was invested in these office assets. So you're not seeing a lot of foreclosures or even threatened foreclosures or anything of that at this point in time. There are a handful, there always are going to be, but for the most part, the owners had substantial amount of cash investments in these assets and can weather this, this short-term pandemic issue that we're dealing with.
Yeah, and Chris, one thing I would add to what Steve said, just as it relates to the debt, and going back to Tollway Towers, really a testament to the buyer and to Steve and his team to sort of stick through that through a long year to get that work towards closing there. But with respect to the office environment and debt capital, I think 2020 definitely saw a focus on existing relationships. So guys like Steve and Jeff, who have tremendous track record as sponsors, they were having success with relationship banks, but it was very hard to form new lending relationships in 2020. We're starting to see that soften a little bit as people are, coming back from what was a challenging year, and from a getting debt capital out, they want to start hitting allocations and starting to get capital flowing out the door. But as it relates to office, there is still very much an increased focus on cash flow. So, lenders are going to be focused on collections. To Steve's point, they're going to be focused on what the leverage level it is. But where we're seeing probably the most depth and liquidity on the debt capital markets is very similar to where we're seeing the most depth from an equity perspective is, deals with cash flow. So multi-tenant deals with long dated WALT, or single tenant deals with term. And in that space, we're probably seeing financing and interest rates at all-time lows. I mean, life companies into the mid-twos at moderate leverage for cash flowing assets and high-quality real estate. And even to Steve mentioned CMBS at 4% on Tollway Towers. That market has probably come in 50 to 60 basis points from that to today. So the availability of debt capital is certainly helping us on the sales side as well.
Great. No, that's perfect. I appreciate that, gentlemen. And so let's maybe switch gears a little bit. We'll take this a little more in the development direction. So Steve, Grant, and Chris, you can jump in too, but want to focus a little more on hot development markets. I know this panel has a little more of a North Texas flair to it, but thought we could kind of talk a little bit about North Texas and maybe the other markets too. I've got a few failures that show how hot some of the other markets are, but Steve, Grant, maybe we'll turn it over. Let's talk a little bit about hot development submarkets, and we can kind of go from there.
Grant, go ahead.
Well, I think as far as the development submarkets, you're certainly going to see them in the usual suspects. Obviously, Uptown's going to continue to be a very active submarket. Anything north, Legacy, Tollway, McKinney, Allen, going to be very attractive submarkets. And Chris, you can probably speak to the attractiveness of those submarkets from a speculative basis as much as anybody can, or from a user basis. But obviously that's where we've seen a lot of the talent. We've seen a lot of the push from a labor pool standpoint to be able to support those types of developments.
Yeah, and I'll jump in here, Grant. Appreciate that. It's the Frisco Plano submarket. We've got a large holding up here, and our second office building just delivered in February of 2020. So it's nice to be able to have a success story. We got it to 93% about last week. So to be able to facilitate leasing during the pandemic was a real blessing, but I think it speaks more to the strength of the submarket, as you were saying. I think Texas, from an in-migration standpoint, the previous panel talked about it quite a bit, but I think we're going to continue to reap those benefits. And I think when you're in the great submarkets, they're going to continue to perform, to your point. And, I was talking about a failure. So Austin, to Chris's point, from a development perspective, has also had the same kind of desire to be there. It seems like there's a lot of capital and developers trying to get into that market. If they weren't already there, there were tons of great developers already in the market. We've tried multiple times, and especially on the office side, had a little harder time getting in there. So I think the limitation of product plus the migration to that market's also kind of fueled a tough market there. But definitely agree with you. I think that in-migration will continue that. And Steve, maybe you have anything, I kind of cut you off there.
We asked this question the other day on our prep call. Will we see a true spec office building start in 2021? And I couldn't answer that question. I mean, there are certainly some very well capitalized developers that have been able to keep building regardless of cycles. And Lucy Billingsley is one of those at Cypress Waters. Craig Hall at Hall Office Park is looking at a very substantial redevelopment of that project. The question is, will they start something spec this year? I don't know. I see Jeremy's picture on the call right now. He and Bill and their team have done a terrific job getting projects going. And I guess if anybody can pull one out of the hat and get one going in 2021, it might be Bill and Jeremy and their team. We're not, a champion. We're not looking at anything from a new office development perspective. We do have 2 large redevelopments going. We have the old Dr. Pepper campus in Legacy, which is 300,000 square feet. They'll move out in about 2 months and we'll start renovating that. And then we have a building in Las Colinas, 4,000 Horizon Way, which has 200,000 square feet of vacancy that we are under renovation on now. So, if you have a asset that is vacant or going vacant, you're going to have to spend the dollars from a redevelopment and renovation perspective to make it competitive for tenants. There's no way to get around that. So we're undertaking those 2 big projects now, but we don't see for us looking at any kind of new office development till at least 2022 at this point.
Well, and I mean, if you look at it from a statistics standpoint, you got 7.6 million square feet under construction, 54.3% of it is already pre-leased. So, I mean, that seems to be the general trend of don't go 100% spec.
Yeah, one thing I would add to what Grant said, talking about hot submarkets from a development perspective, one of the stats we tend to pay attention to quite a bit on the sales side is, what's the under construction totals as a percent of total inventory. And, Austin is almost 8%, which leads the country. Right behind that's probably Nashville. And I think everyone's probably sick and tired of hearing about how great Austin and Nashville are, but that's the reality. And so there's been a lot of development there. I think as it relates to Dallas, which goes to my comment about why, I think about Dallas as a really compelling investment opportunity is, that 7.6 million square feet that Grant referenced, that's the lowest that I can remember it has been in the past probably 5 to 7 years. It's felt like it's always been 10 to 12 million square feet. Now, Dallas has phenomenal developers like Chris and Steve and Grant and everybody else on this call and we have plentiful land to go build and plenty of tenants coming. So a lot of that is build to suit activity. But it's starting to feel pretty good. We're sub 2% as a percent of under construction as a percent of inventory. And I think that's going to continue to dwindle because of what Steve mentioned earlier. To get a spec development deal off the ground right now would be very challenged, not just from a debt perspective, but also from an equity perspective. When you look at new development from an institutional perspective, unless it's someone like Lucy or Craig Hall who has capital in-house and a longer term perspective, or like you guys, Chris, at Van Trust, it's difficult for a traditional merchant developer to go and raise institutional equity right now. It's for an office deal. So I'm optimistic relative to maybe the lack of new development, which should hopefully help operating fundamentals and for all landlords here, and certainly help us from a sales perspective. But as you look at DFW, I mean, Uptown is always still going to attract development capital. It's just, it is our young urban infill, fresh out of college location for capital and talent. So that, I think we'll always see that. But I do think that there's starting to be a divergence and people really thinking about controlling their environment from a user perspective in suburban markets. So I wouldn't be surprised if we see a bit more single story development. If you can find land to make sense of building single story, just given where land prices are, it's tough to make sense of that. But I think it was one of the guys earlier was just talking about representing tenants who are coming out of these mid-rise product and going towards single story product. I think that trend is going to continue where you can be a tenant where your usable square footage is a lot closer to your rentable square footage, and you can not have a bunch of common areas and walk right into your space. So from a development perspective, I could see some of that, that type of product coming into the market in a more meaningful way. But as we all know here in Dallas, it sort of begins and ends with Uptown and Legacy first and foremost from a development perspective, and I think that will continue.
I will play devil's advocate there as far as the single tenant product versus the multi-story product. I think it just depends who it is and where they are and what their comfort level is, especially as it relates to COVID. We had a corporate relocation coming from the West Coast, and we were touring lower floor buildings. And I think I shared this with Chris and Steve. Eventually the CEO comes on, pulls me aside and says, why are we looking at low floors in office buildings? And I said, well, your CFO had said that we wanted to be careful and so forth. And he goes, man, let's start looking at some higher floors. And next thing we know, we're looking at 15, 16, 17, 18 story, or floor of the building. And he goes, this is what I'm talking about. This is where I want to be. I want to be where I got some views and where I can see. And so I think I'm careful to apply, short-term variables over the long term to make long-term assessments, because I'm not sure it's going to be as active in 5 years in that particular space as it is today. I think that there's always going to be a need for that. I mean, anybody on this call has heard people want 10,000 square foot and 20,000 square foot office buildings that just don't make a whole lot of financial sense from a development standpoint, from a land cost standpoint. And so I guess I caution people on making that generalization long term. Steve and Chris, I'd love to get your thought on that as well.
Well, I think, and I made this comment on the last panel, which, by the way, Nick and Jeremy and Sharon Alice did a great job. We're seeing it today, the big corporate users are not back to work yet, okay? The banks, the large corporations, they're scared to death to go back to work from a liability perspective, period. The small entrepreneurial companies, the tenants that are leasing anywhere from 2,000 to 20,000 feet are typically back to work. All of you guys are sitting in your offices. I would be in my office versus my kitchen, but I've got COVID. I'm on day 8 or 9. So, I'm in COVID quarantine, but, so tenants that are 15, 20, 25,000 feet, I think are still going to gravitate to, especially if they're in an industry that's high paying, they're going to gravitate to Uptown or Legacy or the multi-tenant buildings in Legacy, where they can get a great environment. So long as the management and operations of those buildings are being done in a way that makes them feel safe and secure today during COVID and in the future down the road, that's the kind of buildings they're going to want to be in. Chris McCluskey saw it in the lease up of his latest Frisco Station project. It went multi-tenant. They've got some great companies in there that probably are still paying rents that are as high as you can get in the market. But I do think if you look at the larger companies, and we saw it with Vistra Energy out in Las Colinas leasing the building on, I forget what it's called, on 114. They only wanted effectively 300,000 feet, but they ended up taking the whole 400,000 square foot building because they wanted to completely control their own environment. And they didn't want to be in a building where another tenant was going to potentially be in there. So I do think we're going to see the larger space users really want to be in their own buildings. And that opportunity is going to exist for a time period here with some of these larger vacancies available to go into some existing assets. But once those are leased and dry up, then they're going to have to go into new development, whether it's, Chris McCluskey cranking up another big spec building or it's a build to suit. So I think there's a dichotomy in the experience you had, Grant, that CEO going, I don't know how big they were, maybe 10, 20,000 feet, saying, hey, I want to be on a higher floor with views, and I'm perfectly fine being in a multi-tenant building.
Right.
Yeah, no, I'll echo what Steve said. That it's a great synopsis. We've definitely seen the tenant profile transition. We were really blessed in our first building to have 2-floor, 3-floor tenants kind of take most of the building. And then as we switched over to our second 210,000 square foot building, it really transitioned more of that, to your point, 2,000 to 20,000 square foot tenant. They were coming up on the end of a lease expiration and could make decisions and move quickly, where the corporate tenants tended to feel like they're still trying to figure out exactly what that means post-COVID. And so to your point, I think we'll start to see some of the larger tenants taking full buildings. And so maybe it's not the 20,000 square foot building, but it's not the high rise. Maybe it's something in between for a little while, but definitely agree with both of you. I think there's kind of two sides to the coin there for sure. So maybe we'll, since that's a good segue, we'll roll that into kind of things that we're seeing post-COVID tenant request. Grant, I know you've got a lot of tenants in the market. Steve and Chris, you see some of this too.
Yeah. There's two schools of thought. There's what's within the confines of the tenant space, and then outside of the tenant space. And there's been some pushback and back and forth as it relates to who's responsible for what's necessary, what's not necessary. The first one that came into play was really within the confines of the tenant space, making sure that the space was safe, comfortable, had social distancing for employees, had enough PPE, and that was the initial take with a lot of tenants, landlords, in that there was a shift to, hey, look, that's a OSHA issue, that's a tenant issue, we'll just keep it within the confines of the space. Then, a lot of very forward-thinking landlords like you, Chris, and you, Steve, they started saying, well, how do we get out in front of this? How do we stay ahead of it? So they started looking at their HVAC systems. They started looking at elevators, air exchange in the elevator, which I'm not sure there were very many of those being contemplated prior to this. They started thinking about how they can have touchless buttons, doors, self-sanitizing buttons, what they can do in order to be able to provide a common area and a space that was comfortable, increasing the day porters and the janitorial staff and making sure that people would gravitate to that building. And long term, I think those people that grasp that concept sooner than later are going to end up much more successful, because it's, to a certain extent, it's kind of like we did with energy certification. If you remember, Dallas was a gross market. Then natural gas prices went through the roof. We started stripping out the electricity, and it was, hey, look, it's a tenant problem. You figure that out. And it was a tenant problem until it was, $3 electricity per foot in a building, and that the tenant said, no, I'm not going to do that. These guys have been negotiating energy contracts next door. They're $1.50. I'm going to save $1.50 by going next door. And then everybody caught on to that concept and said, hey, listen, we got to start making our buildings more efficient. We got to start making our HVAC systems more efficient. We got to start making sure that we, hedge our energy contracts and make sure that this building is efficient as possible. Then the other thing that we saw is the code compliance and the code enforcement. At state level, on a permitting level, we started seeing building codes that encouraged sustainable building practice, that encouraged efficient building design. And, one of the things that we talked about is I would anticipate there's going to be some sort of COVID certification, like a LEED certification or like a WELL certification. To my knowledge, I haven't seen one yet. There's been a lot of talk about it, but when that comes out, I think it's going to be a lot like LEED certification was when it first came out. If you wanted to have LEED certification when it first came out, you had to work really hard to be able to get to that, and it was a huge step when your building achieved LEED certification. At this point, the building codes have changed to where, for the most part, save some check the box items, we said like a bicycle rack. you're pretty much going to be building buildings that will be able to achieve LEED certification just because that's what the code is requiring in this area. And so, the thing about COVID is that it's something that for a long, long time is going to be in the back of minds of people that have experienced this pandemic. And what that means is people are always going to want to find a place that's safe. They're always going to have the idea of wanting to be social distancing. I mean, I don't know about you, but it's going to be a really, really long time, if ever, before I'm crammed into a subway with, 50 people that are up against me that I don't know. Same thing with office space design, same thing with office building designs, and I think it's going to just blend into the fabric, kind of like security did with September 11th. We have a lot more security everywhere. It blends into the fabric. It may not be as apparent as it was when it first, when we first had September 11th. Same thing with design and health standards. I mean, I'm going to be washing my hands for a long time. I'm probably always going to be carrying hand sanitizer, and I'm going to want the building janitorial staff to wipe down the high-touch areas and make sure that the building design is something that's safe and healthy. And, we talked about some of the building designs that, were really ahead of their time. And, maybe they weren't the perfect design, but one of the things that we talked about on our pre-call was, when the IntelliCenter came out, the idea of, we're going to have this building, excuse me, we're going to have this building that's designed that fosters wellness and allows for a healthier employee so that your employees have fewer sick days. I guess I'm a late adopter in that I didn't really see the value of spending extra money to have all of these systems that could help with that. I think that now everybody looks at it and says, man, I want my employee force or my labor force to be as healthy as possible. We don't want sick days. We want them to be as safe as possible. And so people are going to look to mirror that in their office designs, in their office buildings. And so I think that's a great big wave that we're experiencing now that's going to be trickling down through the pipeline.
Steve, I know you've got the large redevelopment in play. Do you have, any more insight or anything you want to echo on Grant? Grant did a great job. So I think what we talked about.
It's interesting. On the two big projects we have in redevelopment, we've got HKS on the one in Legacy, and we have DLR on the one in Las Colinas. And both of those groups have done a terrific job incorporating into these renovation plans things that are different because of COVID. How you design your lounges, how you space out furniture, even on mechanical systems with airflow. Grant touched on existing office buildings. COVID, it's almost been a year now since we went into lockdown, but we immediately did 4 things that you had to do, which we'd call the low-hanging fruit. You had to put signage throughout your building, telling people to, 2 people per elevator, wash your hands, etc. We put sanitizing stations throughout all the common areas. Third is we all upgraded our filters to a higher level of filtration. And most people went as high as they could get without stressing their particular system. So if you have a 1980s building, you can only do so much, but you could still upgrade the filters. And then fourth is on the cleaning. You enhanced your cleaning protocol, paid more money to maybe add a day porter, add extra services at night to do what, as Grant said, really get in there and wipe down these high touch surfaces. So those are the 4 things every landlord went out and had to do immediately in order to make people feel comfortable coming back to an office building. Which from a psychological perspective, I think there's been some interesting dynamics too. Back in March and April, you would get a notice from your landlord that said, hey, there was a COVID case in the building. They can't tell you who it is, where it happened. Everybody freaked out, right? oh my God, we got to go home. We can't come back for a few days. Today, you get a COVID notice once a week that, hey, our building had a COVID situation. We did the cleaning, we did this and that, and now nobody, cares. They care, but they're not like freaking out saying, oh man, I got to go home for the next 10 days. So there's been a little bit of a psychological shift as well. I do agree with Grant. I think we're all going to have hand sanitizer. We're all going to wash our hands more. We're all going to have masks. I mean, I got masks in my glove box, in my, kitchen, you name it. We all have masks everywhere. And, even after vaccinations and everything else, I think it's going to be somewhat of a norm in some situations. You're going to keep wearing a mask just because it makes you feel safer. So, what's interesting though, a new development with things like HVAC systems, how your entry doors work, going to touchless entry, touchless elevators. You're going to see a lot more of that technology now get fully adopted in new office building design, and it should. I mean, the newer buildings, the next generation of office buildings are going to be pretty high tech when it comes to being able to, walk in, and maybe because you have your access card in your wallet, it just reads automatically. You walk in a door that opens up, you walk into the elevator bank, it knows exactly where you want to go. Therefore, the elevator opens up. I think you're going to see a lot of that, which will be really cool for this next generation of office that gets built, call it in the mid to late 20s.
Steve, you touched on something that reminded me. It's the technology for all of these systems. We've been putting so much technology in the buildings, and there really wasn't ever any thought about health or employee wellness, but we had technology like card readers and all these, systems that were smart systems. And it's almost one of those that you go, oh man, I can't believe that I just now realized that. And you're kind of going, well, why didn't we do that before?
Yeah. And the health and wellness used to be a fitness center, right? So
right.
Our health and wellness program is we have a fitness center. I will tell you one thing that we are doing differently in our fitness centers. Instead of having large open male and female separate locker rooms, we're moving to individual 4 to 6 individual restroom, shower, sink areas that are high end that allow an individual to use that particular restroom after they work out, before they work out. And then you'll have your cleaning staff go in and just make sure they're cleaning every time. So you're not, we're getting rid of the communal changing the locker room area and creating individual privacy, areas. The lockers may be in an area that's open to everybody, but then you can go into your separate stall that has the shower, toilet, and a sink in it.
Yeah, I believe Peloton in their office space is going to that design for the bathrooms, where it is an individualized, enclosed bathroom that incorporates a sink, a toilet. And so we'll see how that plays out. But the idea is that it's all enclosed and individualized.
Great, guys. I hate to cut you off here. It's some great conversation, but wanted to leave just a couple minutes for some questions. We got a good one through the chat forum, so I thought I'd pitch it out to you and maybe we could get that answered before we get pulled off stage. So the question is, are lenders requiring total overhaul of force majeure clauses, and how's this playing out in lease negotiations? So I know Chris and Steve and Grant, you guys all touch on that. I'll just turn it over to you.
On the lease side, we've not seen, quote, COVID language being added into the leases we've done in the last year. And the whole aspect of force majeure, as it relates to, and typically it relates to the delivery of improvements on construction, or it can be why you're not in your space. I think the insurance industry is still working through the idea of a company making an insurance claim because they couldn't use their offices. Right now, I think the way it's playing out is it's not a valid claim. that COVID was not a viable business interruption claim for tenants to make, especially when they were able to go get PPP funds, which allowed them to pay rent. So we've not seen a major overhaul of force majeure language.
It's been pretty well established that force majeure is not an applicable claim from a tenant lease standpoint. We have seen it incorporated in some of the PSAs, though, in terms of delays due to unforeseeable forces. Whether it be, in some other parts of the country, especially getting an entity set up it used to be a day process. Now it's like a 30 or a 45-day process to establish those. And then it's been harder to get things done. I mean, great example, we had a survey crew where the crew got COVID the day before they were supposed to survey the property. And I mean, that's something that a year and a half ago, I would have said, nah, they'll just go out there and survey it. And, that interrupted the process. So we have seen some addition in some of the PSAs as it relates to extending some of the timelines because of these semi-force majeure issues. I mean, they're addressed as force majeure in the PSA, but they're specifically accounted for as COVID issues.
Wonderful. Well, thanks, Grant. And Todd, I believe this is kind of the end of ours. I want to say thanks to Grant, Steve, and Chris Murphy. So we'll turn it over to you, Todd.
Fantastic. Thank you, gentlemen. Another
y'all.
Wonderful panel. You only have to stick with us for half an hour longer. We've got two interior people, talk tenant improvements coming up. So Rachel and Sherry, if you're on, pop on your cameras and your microphones. Gentlemen, if you want to stick around from the last panel, just turn your camera off and your microphone off, and you can stay right where you're at and watch the rest of this. I'm moderating, so this is going to be a gem.
Wonderful.
Actually, I have two awesome panelists, so they're going to make it super easy for us. So, ladies, I'm going to let you introduce yourselves while I flash up on the screen your contact info and where you work. And then we'll just kick it off and start rolling right away because we only got a half hour.
Rachel, you want to go first?
All right. Hi, everybody. I'm Rachel Rouse. I'm the Director of Interiors at HOK's Dallas office.
And hi, everyone. I'm Cherry Weislong with Gensler. I'm a partner in the Dallas office.
Well, you made that short and sweet. I was hoping for a little bit of edification. I probably should have learned more about you.
We can tell you some more about us if you'd like us to.
Yeah,
we'll work it in. Right, we'll work it in. Well, so I have to apologize to the audience, everybody that was looking at the agenda. Somehow or another, an agenda that was made for a completely innocuous environment about interior design, which was probably to most people sort of a meh item a year or two ago, has suddenly become the forefront of what's going on in office today, is how are we using our spaces and how are we relooking at that? So our bullet points might not match up exactly with what we're going to talk about, but we're going to hit on more about what's going on with COVID and what's changed. So Rachel, let's just start with you. What about your job is completely different today than it was 12 months ago?
Well, I am working almost entirely from home now, and my entire team is. So we have shifted from collaborating in person, which Sherry will remember, that's how we do things in our industry. It was a radical shift for most of our teams to kind of get used to collaborating online entirely, and we are still almost entirely online. Our company is, they're taking really good care of our health, and they don't want us to, put ourselves at risk unless we absolutely must. So we're pretty restricted to, a client meeting that absolutely has to be done in person. So, we're not, I miss being able to be with people, and honestly, that's particularly in our stage in our careers where you're doing a lot of business development and you're meeting clients, that's become a bigger challenge in this environment. And my little team also went through a move during this process. Our landlord came to us last last April and said, hey, listen, we want to move you guys down to a lower floor because we've got a tenant that wants to take 5 consecutive floors in our building. Would you be willing to do this? We got a really sweet lease deal out of the whole thing and got a brand new space that the landlord paid for. And we're just a couple of floors down from where we were. So we were dealing with all of that at the same time. So it's been.
I got to think everybody wins in that. If
Yeah.
leasing 5 floors in April. Let's do the deal.
Absolutely.
Right? Sherry, so knowing that we've all pivoted, some of these changes seem like they're permanent, but some of them, man, I tell you, I miss people so much. And I try to remind all my panelists to smile because it's the only time all week I get to see somebody smile. Because we're going around like this, right? I can't tell if you're smiling. Have you flown on an airplane? It's miserable because everyone looks grumpy and crabby. Maybe they always were at airports, but I just try to smile.
I have flown on a plane one time, but you're right. There's definitely an energy that's missing because of how we're having to all talk to each other like this. You don't get to feel the energy of people when you walk by them in the office or have that impromptu walk by the desk and ask them a question or hear kind of what's being talked about around you. So that's definitely, that's difficult right now. I think it's really difficult for people. It's harder right now with morale and kind of keeping teams up. It's definitely more of an effort because you have to make the effort to call somebody virtually versus run into them in the office. But I do think that there's a lot of positives that's come out of this as well. I mean, I think it's really important to focus on what some of those are. And we've had to change the way we work with clients like Rachel was talking about, but I'll tell you, we haven't missed a beat in terms of serving our clients. We have found ways to present materials. I mean, that's generally something you do in person. You want to show the physical materials, the carpet, the fabrics and things like that. But we have found successful ways to do that and been able to complete projects from beginning to end virtually. And I think that's pretty amazing. Clients are definitely more tolerant and patient because of how we're having to do it, but it's shown us that we can do it.
You don't miss the smell of the carpet tiles in those meetings where
I don't miss the off-gassing of the materials.
It's toxic, Todd. You don't want that.
Well, so we got this push-pull. How are you dealing with it when you're with your clients? Because the reality of we know we want to be in the office and close together because that's how we're humans. We like that. How do you balance that? And what are you talking with your clients about?
So, I mean, the clients I'm working with, they're all pretty much still at home. There's the occasional person who's in the office, like we've seen with some of the panelists this morning. But most people are still at home. And so they're just, like I said, everyone's being patient and tolerant and open to new ideas on how we, meet about things. Even when it comes to construction projects, we can't always be on site. It's just sometimes it's too dangerous or they're trying to keep the crews safe. And so we're FaceTiming with cameras when we're having to look at things on site if we can't be there in person. And we're just all making it work. But, I think in all Gensler's very big in research. We do a lot of surveys and we've done a couple during COVID at the very beginning and also one in the fall. And we've seen how things have changed. And the majority of the people want to be back in the office for some period of time. They want that hybrid working model. They want the flexibility to be able to work from home 1 or 2 days a week. But the majority of the people, they want to be back around each other in the office. They miss the collaboration. They miss the mentorship and the coaching. And quite frankly, some of us are probably just ready to get out of the house and away from our families.
The technology around how we've been working differently with our clients is super cool, Todd. Like I know, and I'm sure Gensler's doing a lot of the same thing. We've been making use of a newer program that we hadn't used much prior to COVID called Concept Board, where we are able to actually put up sort of the same graphics. Like we've done a couple of really fabulous visioning sessions with some new clients, and we've done it all virtually over this program called Concept Board. Everyone who's logged into the program, you send it out to all of your teammates and all of your clients, list of attendees, and everyone is able to move a cursor around in this virtual space, and it has their name attached to it, and they can write, and they can, everybody gets assigned a different color. And we can actually do a lot of the same collaborative things we were doing with these clients beforehand, and we're able to do it virtually. And it has the added benefit of also being really cost effective. The client that I'm gearing up to do this with next week, we've got some team members in California. There are some team members in Washington, D.C. There's us sitting in Dallas. There's some folks in other parts of Texas that will be involved. And so rather than having to pay to fly all of those people to the same place and put them up overnight and, maybe rent a large conference room in a hotel because there's so many folks involved, we're actually able to do this all really well virtually. So, it took a while, it took a mind shift for us to handle it differently, but it's worked out really well.
I would add to that, Rachel, there's another software very similar to what you're talking about called Miro Board. I'm sure others have heard about it. And it's literally like it's moving Post-its, if you will, and things are on a screen. It's like being in a conference room with a bunch of people and just having a major work session and moving things all across. If you're in a room on the wall and you're moving tackable things along the wall, you're writing things on a marker board, all those things, you can do it on this Miro board, and it does make it very easy to still collaborate. This working from home has not stopped us from doing what Rachel and our companies do.
And how have your clients been receptive to it? I don't know if you follow Willie Walker. I like him. He's a debt guy, national CEO of a firm. And he did an interview and he said, look, business travel is coming back because people like to be with people. And he said the driving factor will be when your competition goes on site and you don't, and you lose the deal. You're going to start to say, well, maybe I should have been in the office. Do you think this whole personal preference thing is affecting your design too? Does it, the cavalier person like me who's going to burn my masks the moment I can, versus the person who, like on our last panel, was saying, look, I'm probably going to bring hand sanitizer everywhere I go for the foreseeable future. What are the challenges there?
I mean, oddly enough, Todd, that's something I think both of us have dealt with clients for decades. That's been our entire career, is dealing with the individual personalities that surround, a company, particularly if you're working with take a small law firm where you're really dealing with the personalities of the partners at that firm. I can't just give them the same thing I would give to one of our major national clients where we're rolling out the same process over and over again. I think that I think that might actually be the crux of what we do, is really trying to get to know our clients and learn how they work and be able to provide them with a work experience that truly exemplifies what they do and how they do it. I mean, that's actually kind of the challenge of being an interior designer. And so it's interesting that I feel like the COVID situation has maybe brought that to the forefront and made it a little more obvious to other people. But I feel like that's always been a part of my job, is trying to kind of suss out what people's real personal needs are and be able to give them a space that it lives up to their expectations.
I would completely agree with Rachel, because the success of our projects start with understanding who our clients are from the very beginning. It's not only what maybe that project is, what the drivers are for the project, for the new space, whether it's the financial or economic or aesthetic or community, whatever they're looking for in their new space, but the people you deal with to make those decisions, you really have to understand their personalities, how to work with them. Every project is very customizable with the different people that you work with, because that's what helps make the project successful, is understanding how to have that chemistry and communicate with them well.
Well, I hate to steal your thunder. I don't know how to ask this question without doing it, but we had talked on our call about the HR nightmare one of you brought up, of having this dichotomy of people in the office. So-and-so is sitting too close to me and breathing on me. That's gonna be fun.
Yes. And it's real, you know, I already have staff members who were talking in our annual reviews this last month about, you know, hey, so when we have a plan for coming back to the office, can I just stay home? And so it's going to be a real issue for companies. You know, each company's going to have to really think through what their HR policy is going to be around this sort of thing. It will be very difficult to tell someone who is truly concerned about their health that, nope, I'm sorry, you just have to come into the office whether you like it or not. You know, there's a sticky HR situation just waiting to happen, and it will be very, very interesting to see how individual companies handle it. I mean, you'd say the same thing, wouldn't you, Cherry? I mean,
Yeah, I mean, I don't think there's definitely no one size way to do it. Every company is going to have to do its best. And I think, you know, everyone's worried about the health and safety and well-being of not only your employees, but your families that, you know, go along with those employees. And so it's a tough balance, I think, because you want to keep everyone safe, but you have to be respectful of individual needs too.
And there's only so much space planning can do before Cavalier Todd walks by your cube and starts chit-chatting with you for 30 minutes, not 6 feet away.
Well, and I don't think we can ever go back to, I think it will be very difficult for us to ever go back to the days that, you know, Cherry and I grew up in the industry when, you know, if you weren't planted at your desk at 7 a.m., your manager was wondering where the heck you were and, you know, wondering why you weren't sitting there pretty much the next 12 hours. I don't think we're ever going to really be able to do that. And I don't think that's a bad thing. I actually think giving people the flexibility to be able to work from home, you know, I have small kids, so being able to stop at 5, go get them, get home, and do our normal nighttime routine, and then be able to get back online and actually be effective at 8:30 at night makes a huge difference in my ability to be really good at what I'm doing, in my ability to be, you know, really effective at my job. And I know I have other colleagues who feel the same.
Yeah, and I would add, you know, all of that, as well as people who had long commutes, they're getting all that time back. So they're able to be, you know, that's part of why everybody wants this hybrid model when they go back, because it's offering them the flexibility to make their home life and their work life work much better together. And therefore all parts of those are thriving.
Well, I would have said in April, and it applied to our office as much as anybody, that you all would have gotten a lot of phone calls saying, we're changing everything. We had this layout where we had a game table and it was all built on getting our company to socialize together. And now I want to go the opposite way. I need private offices. I need some big TI dollars from my landlord. Let's scrap this old, why did you guys come up with this plan anyways with a pool table in the middle of our office? But you haven't had that experience, have you?
No, not really. You know, my existing clients who are not not in the process of, you know, changing leases or anything like that, have not called and want to make big changes in their offices. I think a lot of people are just waiting to see what's going to happen. You know, there was that period of time in the summer where some offices started kind of opening back up and people going back in. But with how the numbers have gone up, everyone's really just still at home. So nobody's making big changes in their office. I think they're making plans for what it will be like when they go back in, just like we are. We're a very open office. There are no panels between our desks. And so we're making arrangements on what the plan will be when we go back in the social distancing. I do have a client right now who we're in the middle of designing their space. They're a law firm, and they are kind of trying to plan on what is their new world going to be like. And they're trying to take into account that probably about 20% of the people do want to work from home. So how do we plan their space to where they don't have a lot of real estate just sitting empty when people are working from home? And so the thought is that people who want to work from home 3 or more days a week, they don't get a dedicated space in the office. We'll have some shared spaces. if they happen to be an attorney, there'll be shared attorney offices that are outfitted just like every attorney office. So they get exactly what they would get if they had a dedicated office, but they can't leave anything there. Same thing with like legal secretaries or paralegals. If they're going to work from home the majority of the week, there'll be shared spaces they can come in and work, but they don't get a dedicated space. But if things change in a year or two and everyone's back to always being in the office, we have built the space out to where they can easily make that switch back.
You know, it's interesting that you mentioned that. I've got an accounting firm that I was test fitting for early on, and that's the sort of lease space that they're looking for as well. Only they truly, you know, we did some programming surveys and everything for them to try and help them determine what they really wanted to do. And most of their team is truly saying the hybrid model is what they want when they come back. They maybe have out of 75 people, they maybe have 3 who have said they intend to be in the office every single day of the week, all day long. So those 3 people have a dedicated desk, and the rest of their team has agreed to a flexible desking solution. And it's all centering around, oddly enough, the social aspects of being in the office. You know, you would think that's counterintuitive to the whole COVID situation, but in this group's mind, and you wouldn't think accountants would be that forward-thinking. You know, very, very often an accounting group wants to be incredibly, you know, heads down. But in their mind, the whole point of coming into the office is to have that social interaction. I want you, you know, if you're planning to come into the office, it's because you're going to be sitting and working with the partner and, you know, getting through something, you know, in particular. It's not time for you to do your heads down work. You're coming in specifically to do these collaborative functions. So we've actually been spent like a larger chunk of the real estate is now dedicated to the collaborative functions and the way that they're going to use the space in future. I thought that was really interesting that they were able to come to that conclusion, and they do. They, you know, just like you were saying, Cherry, they have a lot of their staff they found had really long commutes. And so this actually allows them on days when they need to do their heads down work, they can just skip the commute, sit down at their desk, you know, crank through what they need to do. And then when they want to be able to collaborate with their colleagues, that's when they go into the office and they deal with it.
It's got to benefit that. I used to be CPA back in the day, CPA attorney. So I've been there, and they love their private offices. But then when they made a technological switch in the late 90s, early 2000s to go away from paper on the desk, I'm thinking the nightmare of having to actually clean my desk each night before I go home because somebody else may use it. That'll be fun. But I think a lot of these people have gone digital. So
yeah, and this particular team is almost they're like 95% digital. They have a little paper, but it's not a lot. I
can't imagine not having the red pencil to be able to change. That's part of my being as an accountant. I need that.
Yeah, but that's you know, that's the whole idea behind, if you have a shared space and you leave at night, you leave a clean desk. So any of your office supplies or things, you either carry them with you in your bag, or you can get them from the supply closet each day. But when you leave, your desk is clean, and then, you know, a cleaning crew comes in at night and does a good cleaning.
That's going to be a challenge. Well, so where do you see your role in the next 6 to 12 months? And I guess the bigger question is, are you hearing some of these changes are permanent and some are, we have really short memories? So Willie Walker's saying, you know, we got to get back at the way things were before, and people have short memories and we'll move on. As you evolve over the next 6 to 12 months, how do you see your clients leaning towards very conservative? I mean, and another question might be, are we all going to have those big round stickers on the floor where we're supposed to stand at our work desk? Because, you know, it reminds me of being in kindergarten.
So I really think those types of things are going to be temporary. I think I've actually seen a couple of solutions that I forget if it was where a manufacturer had suggested putting like having the carpet fade out around people's desks so that you had the 6 foot, you know, so that it was a little more subtle, that here's where you should probably stand. I'm not recommending to my clients that we go to that extreme, that we try to build, you know, 6 foot barriers into their space. Because I think you're right, Todd. I think people do have a short memory. And I think, you know, there will be some people who will continue to be very, very concerned about it. But I do think for a lot of folks, you know, a year from now, when the vaccines are out and everybody's got one and people are just feeling a little more back to normal, I don't think it'll be necessary to do the dots. And just to give you an idea, my 8-year-old in 3rd grade, and she is, you know, masked and socially distanced, but she is in school in person right now. And she, like the younger kids, it's almost like they're just learning to do a 6 foot bubble around themselves, regardless of the dots. You know, she says, well, you know, now I know what 6 feet is. I don't need to see the dot on the floor because I can tell. I know I'm 6 feet away from that person. And so it's also interesting how quickly that sort of thing just kind of becomes embedded in your brain, and you won't need the dot to know that you should just maybe give people a little more space too.
Yeah, it's like one of the panelists said before, it's gonna become part of the thread a little bit, I think, of who we are as a society, just like after 9/11 did with security. I thought that was a great metaphor. I think some of it's just gonna be stuff people just automatically start doing. You know, we're not seeing a lot of clients though making major changes in their space right now, because I think they're all waiting to see, do I need to add panels, you know, between my workstations? Do I need to do this? It kind of just depends. And so it's right now it's a little bit of a wait and see. No, there's no defined thing about what's going to happen in the next 6 to 12 months when it comes to the workspace.
Okay, so maybe I asked the question wrong. I want to know what's in your crystal ball. So don't tell me wait and see. What do you expect to see?
Well, somebody said earlier, all of the touchless things are not going away.
Correct.
Absolutely. You know, and honestly, we should have been doing that in the first place, and we just weren't. You know, the touchless security, the touchless, you know, faucets on your sinks, a lot of those things are going to not go away because it is more sanitary. And I think this has just brought it forward into people's minds. However, I think like the plastic panels that people put up are definitely going to go away. There's no way anyone wants to work in a plastic bubble long term. You know, that might make you feel good right now if you're one of those people that has to go into the office, you know, and there isn't really the opportunity to, you know, have your own enclosed office. But I do think those are the things that will disappear, the dots, the hand sanitizer probably will stick around in certain locations, but you might not have the sign at the front door anymore asking you to put on the hand sanitizer before you come in.
It gets pushed into the corner. I mean,
yeah.
I think everybody I know likes
sink in the break room, something like that.
All right. So I think I like that you brought up a couple of things, but I like where you're going. Where I drew the line, where I thought this is all out of control. The igloos were a little weird when you see those out on the sidewalk, but I can understand that. But then I saw somebody in California invented a suit, like a space suit that you could go clubbing in, and that you would want to dance with other people dressed in space suits. This can't be real.
I suppose there's a certain element of folks that just really can't stand being at home a second longer.
Put on the spacesuit, then I guess you and your 3 friends can do it. But yeah, I agree with the plastic screens. But although, what do you think of this? The plastic screens at something like a gas station? I don't think that's such a bad idea.
Not
necessarily. Where you get all walks of life coming in and breathing on you all day long.
I will say, I feel like this is all, it has brought some things to light, like Rachel was saying, that were kind of we're kind of behind the scenes, or things that really should have been going on that are better, because this whole, the whole germ thing has now become just so much more. And so I do think things like that are important for everybody's sake, whether it's the employee at, let's use with the example of the gas station, or the, the person coming in to pay. Like there's a lot of stuff that gets spread out there among all of us out in the world. And so I do think there'll be some things like that will change. But inside the workspace, I think it's going to be less drastic.
We're running out of time. I totally agree with you. I was at an architecture firm last week, and about half the people were there, and I got to see some of that software you're talking about. It is cool. It's not the same. You got to be able to touch the stuff, the tile and the carpet and things, but still very amazing. And for sure, somebody that's out of town. So our events, for example, we'll be doing these live broadcasts forever now, because you can watch an event in Dallas while you're on vacation in New York City.
Yeah.
I don't know why anybody go there right now. I guess maybe Florida. Say Florida. I would not go to California right now. Would probably be the top of my list. But we're sort of running out of time. Do either of you have last comments? Feel free to take as long as you like, because we're recording this and putting it on our YouTube channel for people that have to log off right at 10. But so final comments. Let's just start with Rachel.
I would say, just if you're helping a tenant, try to get to know them as best you possibly can to start out with, and that goes for the brokerage group too. It's the sooner everybody can all get on the same page, the faster everything will come together, and the happier everyone will be in the end.
Mm-hmm. Yeah, I would agree with Rachel and just making sure we all have patience, extra patience and tolerance. Nobody really knows what everybody is individually going through. And so if we can have that in the top of our mind when we're getting to know everybody and understand what the needs are for individuals and companies, I think that's just going to make the process so much better for everyone.
I personally think, after doing like 120 webinars, I think I'm on right now, we are headed into probably the most entrepreneurial, explosive market in our history as human beings, because the economy was doing so well coming into this, that everybody is super positive coming out of it, assuming that vaccines continue to work for all these variants and we don't have some kind of a setback. I think you all are going to be busy with companies that are exploding in growth, and it's going to be fun. Mm-hmm. So I'm excited. Let's be positive, get rid of this vaccine. And next year, when we do a Dallas office conference, we're going to be live, right?
Yeah.
And I'll be there. Well, thank you both. Thank you for your time. I put up your contact info. I'll do that one more time. If anybody wants to get a hold of you guys or anybody of our other panelists, you can find that on the website that brought you here in the virtual lobby. Thank you. Have a wonderful afternoon and weekend, and we'll talk to you all soon.
Thanks, everybody. Thanks, Todd.